Hello and welcome back to another video. Something a bit different today. As you can see from the title, a £45,000 experiment. So this is a new portfolio setup, which is more of a passive portfolio. There is some work that goes into it, but it's only once a year. And then I leave the portfolio for a year. And then there's a bit of work involved at the end of the year to set up the next year. So I'm going to run through what this portfolio is and everything to do with it now. So this is all based on my investing checklist. And I've gone through this before, but I will go through it very quickly now because it's very important to building this portfolio. So my checklist score is out of 50 and it is based on financial metrics, and it is to screen out stocks and find the best stocks in terms of momentum, ones that are growing their revenue and earnings per share, so their profitability and their sales, and are due to be growing that, are projected to grow that into the future in the next year or two, so that they've got current momentum and future momentum. So this is the checklist here. This is my earnings snapshot, just not filled in, that many of you will probably have seen on Twitter. So let's just run through a mock as if we're scoring one so I can show you how it works. So earnings per share forecast for the next quarter or half. So quarter if it's the US, half if it's the UK, because we don't do quarters in the UK. So if it's projected less than 10% growth or negative, it doesn't get any points. If it's 10 to 15%, it will get 2 points. 15 to 20%, it will get 6 points. And 20+%, which is what we're looking for, it will get 10 points. We give this question the most points because for me, in terms of momentum of projecting how the stock is going to perform in the next 6 months or so, the most important thing is what its projected earnings are going to be, what's happening in the future. The stock market is forward-looking. If a stock is projected to grow its earnings really well, it's going to probably more than likely perform well. We also want to look at what they have done on their most recent earnings. So these scores will get updated each time a company releases earnings. So we'll be looking through their reports and seeing what growth they achieved in that quarter or half. So it's the same metrics, same numbers. So less than 10% nothing, 10 to 15 2. But then we don't give quite as many points for this one. So it's 15 to 20% 4 instead of 6 on the top. And 20+% will give 6 points rather than 10. Just because we're really emphasizing that forward looking growth. But current and past growth I still think is important to show the quality of a company. So let's just say hypothetically this company got 22% growth in the last quarter, year over year, that would get 6 points. And then we are looking back, so the first three are all earnings per share based. And then we are looking back at their earnings per share CAGR growth, so compounded annual growth rate for the last 3 years. So what was that average growth rate of that EPS for the last 3 years? And it's exactly the same, 2, 4 or 6 points between 15, 20, 20 plus, etc. So let's just say that their average growth rate for the last 3 years was 17%. So we give them 4 points. And the reason I want to look back as well as forward is because there are some, quite often you'll get a stock that is projected to grow really, really well, but it might be a flash in the pan. It might be that they've just had a one-off giant order and it's not sustainable. It might be for a variety of reasons. It might just be that their industry that they're in at the moment is having an explosion, but it's not going to last. It's only going to last for a year or two. And what I want to find is those stocks that are going to have a prolonged growth trajectory that's going to last for several years, ideally. So we want to look back and ensure that the growth that they're on has been like a steady growth and is sustainable and has been going for a few years already. So that's why we look back. And then now we'll get onto sales, onto revenue. So we don't look forward on revenue because I think you don't really get as good projections looking forward. Well, you kind of do, but earnings per share is really what I'm looking at. Profitability is what drives the share price the most. But we will look at what they've done in the most recent quarter. Again, under 10%, no points. 10 to 15, 2 points. 15 to 20%, 4 points. 20 plus, 6 points. So let's say that they did really well and they got over a 20% growth rate. And then we look at the 3-year CAGR for sales as well, and let's just say that that was a 4. So you're already starting to get a story of this stock, that it's been growing reasonably well over the last few years, but growth is accelerating. It's been growing between 15 and 20% for the last 3 years on average, but in this current year, that growth is starting to accelerate above 20%, and it's projected to be accelerating above 20% in the next quarter or half as well. So we've got a stock that's been growing steadily, but starting to accelerate its growth. And then for quality metrics, we'll look at ROCE, so return on capital employed. It's just a metric of how efficiently a company is deploying their capital, make sure they're not wasting money. So I like to put this in it's just a sign of a well-run company, some decent management in there that are controlling the capital well and not wasting investors' money effectively. Same metrics again, 10 to 15 to 15 to 24, 20 plus 6. So let's just say this is a very well-run company. And then liquidity ratio, the current ratio, this is basically just current assets divided by current liabilities. It's just to check, a quick check of the financial health of their balance sheet, check that they're not in any real danger of going bust anytime soon. I want to see over 1.5 to get any points at all from this. So if they have 1.5 million in current assets, I want them to have less than 1 million in current liabilities, so more assets than liabilities basically. And the current assets means we're looking at things like cash, investments, things that they can fairly quickly liquidate, when it doesn't include property and that type of thing that is more slow moving. So ideally we want more than 1.5. So let's just say for the argument's sake that they're fairly liquid. They're not in any danger of going bust, but they haven't got an incredible balance sheet. So we'll give them 2 points. Why is that? I did have a sum in here that calculated it all up. I think I just deleted it. I'll put it back in a second. And then dilution. So this is share dilution. So the amount of shares there are of a company that are available for investors to purchase. I don't really want to see that going up. Obviously for quick growing companies, young tech companies and things, often there will be dilution because they need to raise capital and things for investments and to grow the company. That's fine. But in that situation, I would want to see more points at the top, so faster growth, which means I don't need this so much and it can still pass on little points down here. If we're seeing less growth at the top, then I want that to be compensated by them doing share buybacks or something. So they'll get some points for that to compensate for slow growth, as long as they're doing something positive like share buybacks. So if it's negative, if they're diluting shareholders, they will not get any points here. If it's just level, like it's been 1 million shares for the past 10 years or 5 years, whatever, it's just unchanged, they'll get 2 points. And if they're performing share buybacks and reducing the share count, they'll get 4 points. Let's just say this company's been doing share buybacks, deploying their capital well for the shareholders, they'll get 4 points. Let's just quickly put this back in. I don't know, I must have accidentally deleted it. So it should just be that, shouldn't it? Testing my Excel coding here. So this company gets a score of 42, so that's a strong pass on the checklist. Let's say that they're projected to grow in the next quarter, but only 15 to 20%, so it would get 6 points. That puts them to 38, and it still just passes. So you can see it doesn't have to be perfect across the board. And if that was a 10, it could even be that their revenue growth for the past 3 years has actually only been kind of 7 or 8%. Doesn't get any points at all, but because the future growth is projected to be so strong, it can still pass on the checklist. So that's how the checklist works, just so you understand now when I dive into what I've been doing with this, you kind of know where I'm coming from. So all the videos so far on my channel have been about most of them have been about my public portfolio, which is why I'm actively trading. I have a watch list of stocks that pass the checklist, and I'm waiting for breakouts and things. I'm buying and selling, just actively trading. I did think, because I have these checklist scores for quite a few stocks, do I need to be doing all that work, or could I just buy the lot and just see what happens? So what I did is I created, so it's not 100% accurate because I did this a few months ago and I backtracked to January, the start of the year, and bought basically my top 30 checklist scores. Not, I should explain, not literally the top 30. I did the top so many from each sector. So I did the top 5 from cyclical, the top 3 from defensive, top 6 from industrial, top 6 from healthcare, and the top 10 from technology. And I decided to go for no financial ones, no basic materials, or no energy stocks, just because they're they're just not as good for growth stocks. And basic materials and energy, they're very reliant on commodity prices. So the actual quality of the company, what the management are doing, doesn't really have much to do with it. And financial is quite similar. They're very dependent on how the economy is doing. And I don't understand a lot of financial stocks, so I've just eliminated them as well. And this spread, this might change depending on the market we're in. So if we're in a bear market, I'd probably put the technology down to kind of 4 or 5 and put defensive up to kind of 10. But for this year, we're in a high growth market. I'm going to focus on 10, but I'm still going to have some diversity in there, so we're not just all in tech. 30 stocks. This is not real money. This was just an experiment. I split it. It was a £100,000 portfolio, so roughly £3,300 in each stock, and I just backtracked it to January 1st or whatever date I could actually buy it. It might have been January 2nd, and bought 3,300. Well, I just put it into Stockopedia as if I had bought that at the start of January, just to see how the portfolio would perform. It is up year to date 59.8%. This was if I just bought the top 30 shares on my checklist system at the start of the year, and for the rest of the year had done diddly squat, just done nothing, gone off, played golf, sat on a beach. I would have been up 59.8%, which, considering my active portfolio is only up 14%, it's actually up about 16% now, but in the update I've just done, it was end of November, it was at 14%. It does make you wonder if you need to be doing all of the work that I've been doing. Obviously, this could very legitimately be a one-off. The S&P itself is up kind of 40% or something. I'm not sure what it's up at now, but the S&P 500 is up a ridiculous amount this year, and this is very US based. So obviously, it's not going to be doing 60% every year. This is going to be, I'm assuming, is going to be one of its better years, but it has made me wonder, what am I doing? I could have done this and made 60%. 100,000 portfolio has turned into 168,000. And this is all the stocks that were in there. So I've ordered it. So there are a few UK. I didn't discriminate between UK and US. It was just purely based on the checklist system. If a UK stock had a high enough score, it was in there, but it is inherently probably 70-80% US, just because they had higher checklist scores. I've ordered it by gain, so you can see it is outsized. AppLovin is up 839% this year, a £27,000 profit on a £3,300 entry. So that is skewing things slightly. But you can see most of the positions are in profit, and there's a few that are negative, but they just get far outweighed by the ones that are in profit. So Arista Networks is down 55%, Celsius is down 47%, PDD is down 32%. So there are stocks that are down as well as up, but that's an incredible return. And I figure even if you don't have these massive ones and you have some that go to zero, you're more than likely in most years going to be balanced out by the ones that perform really well, because you are building a portfolio of the highest momentum, highest growth, higher future earnings stocks in the stock market at that time, and you're only holding for a year. So a year is not a huge amount of time for all 30 stocks to go wrong. Is my thinking. So on the back of this, I have decided to actually do it. I have now purchased a passive portfolio. And before purchasing, what I decided was, as I've only had a fraction of the stocks in the stock market actually checklisted with my score. So what I decided is, if I was going to do this properly and actually put my hard-earned cash into this and take the risk, I was going to do a checklist score for every stock in the UK stock market and every stock in the US stock market, with a caveat. Every stock in the UK stock market that isn't financials, basic materials or energy, that is above a 25 million market cap, and the same for the US, but above a 5 billion market cap. Two reasons for the 5 billion. One, I need to be able to buy it. And a lot of the micro cap stocks, the US stocks, aren't on AJ Bell, which is my broker. And B, there's just so many stocks in the US market that even having above 5 billion and excluding a lot of sectors was still around 750, 800 stocks. So I spent a good week and a half going through, so this is the UK one, every stock. So this is a cyclical tab, so the stocks on the side, and then this is the checklist, EPS forecast, this is the scores going through, the total, and then just what subsector it's in. That's not really that relevant, it's just my personal interest. So this is for all the cyclical UK stocks, all of them above 25 million market cap. This is for all the defensive stocks, all the industrial stocks, all the healthcare stocks, and all the technology stocks. And then what I would do is, and now I can order, so this is alphabetical, but obviously because I've put it into a spreadsheet, I can now order it by checklist score. So that way. And we get the top checklist scores. And if I wanted to, I could order by any of the different categories in the checklist, or I can order by subsector. So if there was a period where home building and construction was in a massive bull market, I could go into here, order into this category. I can see what the strongest home building and construction stocks are. So we can see the best one at the moment is Cairn Homes. And then there's a huge drop off for my checklist system down to ECEL. I don't actually know what that is. But you can see if gambling, well, let's use a different example than that. Hotels and entertainment. So this is probably going to take a knock at the moment. It's probably not something I want to invest in with the rise in national insurance and all of that. But maybe I don't do shorting. But if I did want to do shorting, I could go into this and look at the worst one. So Entain, I think it's called, only scores a 2. That might be a candidate for shorting potentially. I don't do shorting, but just to give an example of how this is all set up. And then I did the same for the US stock market. It took a little longer because there's a lot more stocks. So cyclical, defensive, industrial, healthcare, technology. There's a lot of technology. And you bear in mind that all of these are above a 5 billion market cap. There's a lot of big companies in the US. So I did this, ordered them by checklist score. So obviously, if you want, you can screenshot this and look at them. I'm not going to go through every tab, but there's the US technology ones. And I went through and this is the actual portfolio. I went through and I changed it slightly, so it's a bit more diversified. So I did 5 of each: cyclical, defensive, industrial, and healthcare. So I didn't, in the previous one, I had 3 defensive, 6 industrial. I just went 5 across the board for them and 10 for technology, just because there's so many high quality, high growth technology stocks. I do want to make sure that they make up a decent part of the portfolio. So 30 stocks in total. We did not go for 100,000. I don't want to take that big a risk to start with. I want to run this and see how it goes. I can't see, I think worst case scenario, even if we go into a massive bear market in 2025, maybe it loses, worst case scenario 50%. And then in terms of my overall portfolio, it's not disastrous. So what we've done is we've done £1,500 roughly for each stock to make up a £45,000 portfolio. And I bought these on the 2nd of December, because the 1st of December was a Sunday. But I went through and bought all of them the same amount on the 1st of December. There was a little bit of difficulty, especially with the US stocks, because a lot of them are quite high share prices. So to get around 1,500 was a bit complicated. Some were a bit below 1,400 and some went a bit above, but very roughly. And we are going to hold this. I did it on the 1st of December rather than the 1st of January for 2 reasons. Basically, I was just excited. I'd just been doing all of the spreadsheets and I just wanted to get going. And I figured it doesn't really matter what time, it's just arbitrary. And also I think the 1st of December makes sense because December's normally quite a good month, so we get off to a good start. Just mentally, that would be good. But also, we've just had earnings season through November. So all of the checklist scores for the US stocks are kind of fresh and up to date. UK's a lot more spread out, so there's not really a defined time when all the earnings will come. So waiting for January, those checklist scores are already a couple of months old, so I think it makes sense to do it in December anyway. So I'll probably hold December 1st to December 1st, but I might hold until January and just start doing it as a true annual thing. But yeah, this is the portfolio. As you can see, we bought then, we are already up 0.57%. Woo! And I will order it. Now, there's not much point in ordering it by gains just yet. But you can see I'm already up 11.9% on Supermicro Computer. But I am down on a lot. All of these that are down kind of 2% or less, that's just the spread and trading fees and things. They're not actually down. But Transmedics is down 17% already. But I will order it alphabetically. And one thing I will say is there are some stocks in here that I probably wouldn't have picked, but I've decided to just trust the checklist system. So Supermicro Computer, some people may be thinking it before I say it, but they've just had like some issues with their auditing and stuff. One of their auditors has kind of resigned, so they have got some issues going on at the moment, which is one of the reasons why the share price is falling hugely. But I'm just trusting the checklist system for now. If it falls and it turns into a disaster, then it's just 1 of 30. And similar to Taiwan semi-manufacturing company, I wouldn't actually own that. I wouldn't trade that normally because just of the risk of it being in Taiwan and the China thing and all of them potentially invading and all of that. I think that's probably blown way out of proportion, but I just haven't touched it in the past for those reasons. But I'm just going to trust the checklist system. It is a tech stock. It's scored really well on the checklist system, so we're gonna put it in there. So this, I'll just go through this slowly. It's in alphabetical order, but you can stop and look at what's in there if you really want to. And if you really want to, you can copy it. I wouldn't suggest you do that because, as I say, this is very much an experiment. This could end up being a disaster, and that last year this year that we're in 2024 was a flash in the pan, and next year it's down 30% or something, I don't know. So if you do copy it, on your head be it. I take no responsibility whatsoever. But hopefully it works. And then, when we get round to next, I'm not touching this now for a year. I think I'll do periodic updates, maybe just tag them onto my monthly portfolio updates of the public portfolio of how it's doing. But once we get to the end of the year, I will go back through these spreadsheets and redo it for every stock again. As I say, it's about a week and a half's work. But I was doing other things in those days as well, so it's probably like a good 3 or 4 days of solid full day work. So in terms of a year portfolio, it's not that much work really. In terms of a percentage of a year, for the rest of the year you can just sit back if it is successful. But at the end of the year, I'll redo it, get the new top 30 stocks. If a stock falls off, so if equals isn't on there come next year, I will sell it. If there's a stock that's on there that was on it this year that's still on it next year, I will sell it down to, or buy more if it's not in profit, to the 1/30th of the portfolio. And hopefully the valuation of the portfolio will go up. So if it goes up to 60,000, then it'll be £2,000 per position. I'll still divide it by 30 and we'll just do it for whatever the size of the portfolio is. So we'll see. I'm hoping that this works. I think for a proper test, which is one of the reasons I've started, 45,000 is a lot of money, but compared, my public portfolio is 100,000, so we're not going on that level. It's a position that like I say, if I lost 50%, it's not going to destroy me. One of the reasons for starting small is I want it to run for several years. I'm just going to keep doing this because you can't tell. There's no way of telling if this is actually a successful strategy until it's been running for, realistically, probably 20, 30 years. But I think 5-10 years will be enough to tell how it's doing. Hopefully it grows and just naturally grows without me putting any more capital in. But if it is proving really successful, I might add some money to it as well, and we'll see how it does. But what I'm very curious of is I'm still going to be doing the public portfolio, so active trading. I'm just curious to see how I do versus this. If this beats me next year, then I'll still carry on active trading because it's just 1 year. But if we get 4 or 5 years down the line from here, and every single year the passive portfolio has beaten me, then there's no point in me doing active trading, is there? If neither beat the S&P, then I'll just do a tracker. But I want to give myself 4 or 5 years of really diving into this and to see if I can beat the markets. But if this is beating the S&P but I'm not, or this is beating the S&P and I am, but this is doing better than me, then I may as well just do this each year, 3 days of work, buy the portfolio, and then go off and do something else for the rest of the year. There's no point in just spending almost a full-time job doing this if it's not needed. I can free up my time to do something else. Anyway, that is the passive momentum portfolio, as I've coined it. We will see how it goes. I'll say the £45,000 experiment. And I will do, I won't do monthly updates because it won't change much, but quarterly updates maybe. And I'll certainly do annual reviews and reloading the next checklist. The next selection of the checklist. Okay, what do you think of this? Do you think it's going to be successful? Do you think there's anything I should change or tweak? Have any of you ever tried anything like this? Really curious of all of those types of questions. Please do let me know. If we could get a conversation going in the comments on this idea, that would be amazing. As I say, this is just a big experiment, and I'm just really curious to see how it's going to turn out. It's quite fun, actually. So yeah, thank you for watching. Subscribe if you're not already. I'll see you in the next video.